Hey guys, welcome you all again on my channel Stay Up. So guys, I'm here to discuss a very important indicator. As you can see, the economic indicator. So some like 5 indicator that I would be discussing in this video. But before jumping to the content, if you haven't subscribed my channel guys, do subscribe and stay. So let's start with the video guys. So guys, as you can see on the screen, the first that is a first chart. There are two charts. So the other headline is contain consumer price inflation. So first the chart that would be discussing is the consumer price inflation. That in shortcut it is also called as CPI. That is India versus world in percentage term. So there are four line you can see here. That's world, advanced economics, emerging market and developing economics, and India. As you can see the world's which shows the average CPI in across the countries, which is around 3.8 some percentage during 2018, whereas India's lies around 3.5 or 6 something in 2018. But we know the currently the CPI has reached to 3.99%, and 1 month back it was around 3.15%. And this increase sudden because the RBI recently cut the interest rate, which leads to increase the inflation rate in country currently. If RBI cuts further, there might be chances that the band that is two to between 4 to 6% of CPI has to be maintained as per the central government. It may increase if the RBI cuts the interest rate in December. So let's see. CPI basically shows how the consumer price index in the India and in another country. So that first chart shows, and the second chart, which is a recent trend of India's CPI inflation. That is, it shows the recent. That is in August 2019. You can see that is 3.2%, and in the blue one you are seeing that is a core inflation. Which core inflation means something which is if you exclude power or energy or commodity things, so you will get a proper CPI inflation rate. Guys, now we'll move to the next important indicator, which is industrial production sign of revival. As the you can see the headline, or in shortcut we can say that is IIP, index industrial production. We knew already in week ago that RBI released the data that is the IIP is currently fallen to minus 1.1%, which during July it was 4.6%, which shows that industries or manufacturing sector is growing. But it is lower because economy recession in India is currently is happening. In first you can also see that during the July it was around 4.6%. Now it has reached to 4 1 point minus 1.1%. And in the second graph, if you see the production growth of core industry, that is core industry means that here you can see the steel, cement, or the manufacturing or the mining industry. These are the some eight uh, core things which you should consider for any country if they are growing. And here the steel industry, if you see that is in 19 and 20 quarter one, that suddenly there was a jump. As we know that was government during in during July the government released the budget, so it was expected that the this industry will boom, but it's not happening. And you can see in the during July the steel and the cement was constant, but in quarter one of cement wasn't that much as expected. So it's simply the percentage of the GDP which shows. For any country to grow, IIP is very important. It can be increased only when there's a new investment or the fresh capital is employed in the country in order to bring new manufacturing setup in country. And as we know that already the government has cut the corporate tax rate cut. If any companies come in India and set up a business, that they will be charged only 17% of the corporate tax if 2023 before. So it's a really good initiative from the government after knowing that we are moving toward the recession. We are moving to now third important chart, which revival of the fixed investment. And the annual fixed investment rate percent of GDP, that is around in 1819 it was around 29.3% or something. We consider as a 30% of the GDP. Means the economy of India is 2.5 trillion dollar. That's mean around 750 billion dollars something. That's during 1819 it was investing means the new capital or new investment from the other country or from the domestic from our country itself. They have invested in producing a new raw materials, new inventory, new products and services. Fixed investment doesn't mean that one guy purchase and second guy sell or purchase from between the party. The fixed investment means you have to employ the new or fresh capital in the country in order to produce a new goods and services, which simply shows the country is growing, and it is considered a percentage of GDP. And then second graph we can see the line graph, which shows that during quarter four of 1819 there was sudden drop, and now it is moving, it's showing the positive growth in 1920, and hope so it will grow as government has taken a lots of initiative. Let's see. Now guys, we are moving to the fourth important indicator, is improving fiscal deficit and contain CAD, that is current account deficit. So guys, we know already that the fiscal deficit currently of GDP is around 3 point it was considered to be 3.3%. Now it has moved 3.4%, because there is, because the RBI has already given a 1.76 lakh crore last year, this year itself, to the central government to, and they are using this government to benefit for the country itself, like for many other investment and the projects, and for where they are lagging. So it's will improve the fiscal deficit as well. And the second graph, if you see that current account deficit, that's mean that we are importing less as compared to the export that previous, because we know that recently there is a less import of the oil, because of there is a sudden problem that in the Middle East region because of the war or something between Iran and the Saudi, which on facilitated center in Aramco. So it caused to decrease the import of the oil, which increase the current account deficit for India, and it's showing grow positive as well. And there are so many like projects that government are moving towards the electrical vehicle initiative, which will definitely decrease the import, because to India totally, India brings most of the oil as compared to the other things, that is commodity, or you can see the oil is which fluctuates the price of the Indian rupees or currency. So now, which is important, that is last and important indicator, which is robust FDI inflows and the high foreign exchange reserve. The first chart or graph, the bar graph, you can see that is in a horizontal manner, which is represented that grow FDI inflows. We know that already government has allowed the 100% FDI in mining and the digital towards e-commerce as well. So which is boosting the Indian economy, which was for the shorter period, and hope so in during the long period it will grow. As you can see the here the data, and which is taken from the RBI, that is 27.3 US billion dollars. So there are coming so much of investment in India through FDI, due to the uh, policy that governments have taken. And in the second graph you can see the foreign exchange reserve, that is US billion dollar, which is raised to around 430 billion, which is highest in highest all the time, that is 430 billion dollar, which is highest. And it is really important for any country to maintain the foreign exchange reserve. It can be used during, if the government wants to improve the currency in against the dollar, or if there is a more import of the oil, which reduces the currency. That was all five important indicator, which shows how the economy of any country is doing, and that five indicators should be considered or should be seen, so that individual would know that how the country is doing, or where they are lagging, where the inflation is maintained, or they're in how the manufacturing sector or how FDI rules investment as in countries happening. So guys, if you love this video, please like, share and subscribe. Have a great day guys.